So if you've been following the 11ish approach in good bankroll management, then every one of your investment opportunities are big enough where the gain will be interesting, but small enough where it'll never risk the integrity of your entire bankroll. But we're going to have a pretty sobering conversation today. What happens when your investment opportunity looks like you didn't time it right, or it looks like the shit's about to hit the fan? What do you do next? In this video, we're going to talk about how to objectively look at these situations and figure out your next moves. If this is the type of video you've been looking for, please hit the like button for me. And let's get started. So if you've been using the 11ish approach in bankroll management, hopefully you've been using the 11ish approach in stock selection as well. And what I mean by that is that you looked at the company, you understand its business value, its value proposition, its positive, its negatives, and the time scale in which you would like to make this investment, right? Are you investing it for a 3 to 6 month gain, for a long-term gain? All of these will answer the questions that you'll be looking for next. First and foremost, macroeconomics. Especially if you're looking to invest in a 3 to 6 month period, the macroeconomics probably matters to you a lot more. In other words, what is the entire economy doing right now? Is the bubble about to burst? Is the market getting so frothy the swings are getting higher and lower? If you're investing in a longer time scale, let's say a 2, 3, 5 year time scale, then the macroeconomics doesn't really matter if you're making solid decisions. But if we're talking about 3 to 6 months, this matters a lot. And so you have to ask yourself the question, do you think the macroeconomics makes sense? Outside of the industry and the company you've invested in, does it look like the whole stock market is about to eat shit, right? If that's the case, are you willing to hold through? If not, you probably want to scale down. Now, assuming that the macroeconomics is fine, the next indicator I will look at is re-examine the company that you just invested in the sense that, did new earnings come out for your company or the competitors? Are there new news articles that came out from your company or the competitors in terms of what they're doing? Is the competition catching up? That is an absolute big deal, right? If the competition releases a really exciting earnings report, then the perceived notion from the rest of the retail investors may be that the competition is catching up and the stock investment that you put into is losing market share. If you think that's the case, then potentially, the market's changed. Your winner is no longer a winner. Or if you think that the market has changed, but not as big of a deal as people think it did, then it might be a good opportunity for you to reinvest, put more money into it because the market has overreacted and now there's a buying opportunity. Now, the process of buying more shares when the stock is at a lower price than what you originally have paid for is called averaging down, right? Because the stock price that you bought into is higher. If you buy more, those two prices where you've bought in averages down. So your overall stock purchase would have been lower per share, right? Averaging down. Now, before you do that, there's actually some additional questions I'd like you to consider. One is that if you actually didn't own any shares at the current stock price and what you know now about this company and its competition, would you have bought more shares? Or would you have bought any shares? If the answer is yes, then the next question is, with the amount of shares that you've already put in relative to the size of your entire bankroll in percentages, is it already substantial in terms of like how you look at bankroll management, right? So for example, if you're playing with $4,000 and every solid investment as opposed to a risky investment, you invest up to 25% of your entire bankroll. If that's the case, is this already taking up 25% of your bankroll? Because if the answer is yes, then you should not average down. You're adding more risk. Regardless of how safe you think the investment is, there's always a risk, right? I relate everything back to poker. If I give you a pair of aces as a starting hand, that means that you have a very good hand to start with, but it does not guarantee that you'll win with that hand. So you should never risk all of your money. You should never go all in on a probability that you might win. There is no guarantees in the stock market unless you have insider information. So always take that into consideration for any investment that you make. Now, what I just talked about is a very, very brief but objective way of looking at whether you should be holding and not buying more, selling because you made the wrong decision based on new news, or you just misunderstood before, or averaging down because there's actually a better buying opportunity because the market overreacted. Now, I can't emphasize enough the fact that when you have invested in a stock in the first place, you should never invest in a company just because someone told you, just because I told you or your friend told you that it's a good investment opportunity. Because you have to look at the context, right? These investments, they work in the portfolio of the person who's speaking it. They understand the company that they're investing in. So if you are an outsider investing in an opportunity just because somebody hyped it up for you, when the shit hits the fan, you have to do brand new research. It's a headache. It's extra stress. It's a lot of things that can potentially go wrong, and it can cause knee-jerk reactions, causing you to sell when you don't actually know what's going on, right? Because it's scary seeing your stock just drop out of nowhere, right? So this, again, comes back to my initial point. Invest the 11ish way. Look for scalable, repeatable investment strategies, not one-hit wonders. Aim for bankroll management so that you never risk a lot of money, but always invest enough where it's interesting to you. And invest in opportunities in businesses that you understand. If you don't find anything interesting, I think that's impossible. But if that actually is the case, then I don't suggest you invest at all. For everyone else, which I think is everyone, welcome to the 11ish Collective. I hope you found this useful. Please share this video so that we can help grow the 11ish Collective together. Ultimately, knowledge is wealth, and the more we know as a unit, the faster we make money together. Thanks for watching, and I look forward to working with you next time. Thank you.